This is Duke University.
Next up, I'll bring up Nino Fanlo of SoFi, and SoFi is going to address this issue that is important to a lot of us here, a lot of the students. How many of you guys took on a little debt? Yep, me too. Well, I wish Nino would have talked to us about that beforehand, because he's got a solution. He's going to tell us how to save banking, how to make it more sustainable, and he's going to save the day with presenting on his organization called SoFi. He's the chief financial officer there. Thanks.
Boy, that was a setup. I'm going to save banking. First of all, Nikki did a great presentation. Anybody who has not been to California, please go to Oxnard and go about 50 miles to Santa Barbara County, because you will never leave. It is gorgeous, and you would come up with great ideas while you were sitting there in the sun. It is absolutely beautiful, beautiful. So I think I'm going to move from this. Next one. Okay, great. First, a quick background. I have been in the financial services business for 30 years. I started at metropolitan insurance companies, doing real estate, worked at Credit Suisse, worked for a wealthy, wacky Australian entrepreneur in my late 20s running his US holding company, worked for Goldman Sachs in New York and London running trading desks, moved to California where there's incredible weather, great people, great ideas, everybody's happy, and ended up setting up a lot of businesses at Wells Fargo, becoming the treasurer and chief investment officer. I left with a colleague, a partner, and we started a business. It became a New York Stock Exchange company called KFN after our partners, KKR, myself, Fanlo, and my partner, Netchie's. We ended up selling our business to KKR, became KKR partners, retired, got bored, started working with Golden Gate Capital, another private equity firm, and about a year ago got involved with a fellow that used to work with me with SoFi. So I have some broad understanding of the financial services business and what is kind of going on here. Okay, we don't need this. All right, this is our way to make this about sustainability. When the marketing folks told me, I think a week ago, I was headed to New York, they go, would you mind just taking a small detour and going to speak at Duke? I go, sure, not a problem. What are we speaking about? Sustainability. I go, okay, I'm not sure I really have the appropriate background to speak about sustainability, but I'll give it a shot. These other topics are extraordinarily familiar. Everybody understands the necessity for preserving wildlife. In California, water is probably the single most important thing, and over time I think will be a huge business. There's simply not enough water. And everyone here, I'm sure, has thought about the issues, challenges, and I think a lot of the successes, by the way, going on in the country today in renewable energy in a broad swath. It's probably the most dynamic industry. On Friday afternoon, I was meeting with the Temasek folks from Singapore, and we were talking about SoFi and their plausible involvement, and we spent quite a bit of time talking about their energy investments across the spectrum in the United States. It's a dynamic industry. I'm sure many people here are thinking about it. But financial services would not come up as one of the topics, and it's important to understand why it is relevant to you guys. The financial services business is what fuels all these other ideas. These things can happen either from philanthropy or commerce, and the financial services system today is very, very restrictive for new endeavors and new businesses, and we'll get into that a little bit. And I think that has a real impact on some of the decisions and opportunities for you guys. I saw this slide actually last night, and it's funny. I'm thinking there's a few people close to my age will remember that this is from a film that I would make my kids see every Christmas. It's a Wonderful Life, which is a great film. Jimmy Stewart is our model at SoFi of what we would like to have our relationships be with our customers. We've got the best customers, honestly, that you could ever have. There are folks like you, a couple years out, extraordinarily enthusiastic. I heard the word mentioned earlier, passionate, dynamic, well-educated, very intelligent. That's our customer base. We're thrilled. And we want to make sure we're not, I think this is Mr. Potter in the film. Mr. Potter, the tagline up there, moral hazard, is actually inappropriate. Mr. Potter did not have any moral hazard. It was his bank and his money. And it's important to make a difference. He didn't have any morality, but he didn't suffer from a moral hazard issue. The US economic system over the last decade, I think, suffered more from a moral hazard than a morality issue. And that's an important distinction. I don't think everybody that I worked with over the last 30 years was terribly immoral, but I do think we had a system that the connection that people had between risk and their reward disintegrated. And what we're trying to do at SoFi is try to change some of that dynamic. This is the topic. Again, how many people here actually do borrow money? Wow. Well, usually people make shameless plugs for their business, but since I spend most of my time on our capital raising side, I can make this plug. If you look at a SoFi loan, it is unquestionably better than any of the options you can get from a federal program and better than a private program. And that's because it essentially has every benefit that you can get on a public program. I think that's correct. And it has lower rate, and it has essentially the same flexible terms. And it's a little bit zany that we're doing that, because you go, how the heck can we compete with the federal government? And we'll get into that. But it is really a fantastic loan and a fantastic thing for you to consider if you think about refinancing your loans. That is, for probably most of the people in this room, most of the fixed rate federal alternatives fall into these two programs. When I first started working with SoFi, I think I had never seen a more complex series of lending programs and the government programs for student loans. I think there's like 4 different names at 6 different rates with different thresholds. And in classic government fashion, the lowest rates are given to the riskiest borrowers, and the highest rates are given to the least risky borrowers, because it's not an economic solution, it's a political solution. And it's deeply flawed, therefore, in what it incents and what it fails to incent. Let's see if I can get this. Okay. So this is familiar to most folks. This left-hand slide about the cost of education, I know this because I've got a daughter at Stanford and a son that might actually come back here in 3 weeks and look at Duke. The cost of education has soared. There's a whole host of reasons. That's probably a topic that you guys should take up at another time. I won't get into it, but that's a factual matter. And the result is that the student lending programs have grown dramatically. If you look at consumer debt, the only indebtedness, the only asset that has grown over the last decade is student loan debt. Everything else has actually declined, including mortgage debt, although some of it has declined from defaults. And it's an important thing to understand that this is an indebtedness that comes in fairly early in people's lives. It's not asset specific, it's individual specific, so it cramps out a lot of other economic activity. We were just speaking, the government program is fascinating in that it has the same rates for individuals at every level. If you are a freshman at Duke, or you're a graduate student at Duke, if you are a freshman at the University of Phoenix, or you're an engineering major at Caltech, your rates are the exact same. There is no attempt to make a credit distinction, an experience distinction, and in fact, when you graduate, when we would argue you are the most creditworthy, that's the thrust of our programs, you probably at that time have accumulated the most debt, but you've also accumulated the most experience, and you are, at that time, probably the most attractive from a borrower perspective, but you have the highest rate. It is the program that the government sets up that has the exact opposite of risk and reward. This is my favorite slide when we're talking to investors. When I was sitting with the Stanford Management Company a couple of weeks ago, the fellow who runs it, who's an old friend, John Power, said, okay, I get it. We get the economic premise of SoFi. For-profit schools significantly lift the national average of default rates, significantly. They provide, I think, over 30% of the defaults with something like 14% of the loans. And it's a direct result of what I spoke a second ago, that regardless of the qualifications, the background, and the earnings power, the rates are the same. I would encourage you all, I think there's a company called PayScale that ranks schools and degrees that does really thoughtful work. I think it's based out of Seattle. There's a number of things, and I think last week the government introduced a program that's going to rank schools and some of it is fairly obvious. I don't think anybody in this room is going to have a gestalt moment from looking at those things. But for some folks, it's not without some merit. So if you go off the national average that was skewed, and you then go to nonprofit, private, and public, the numbers go way, way down. They go down dramatically. And if the nation, when you looked at the weekly article, I mean weekly article, because every week we see an article in either the Wall Street Journal or the New York Times explaining this issue, if they focused on those two schools, the articles would go, or these two types of schools, public nonprofit and private nonprofit, we probably have about 1/5 the number of articles that we have about the student lending problem, because people would go, okay, that sounds reasonable. If they then broke it down and said to you, a substantial, I think over half of the defaults that come from people in their freshman, sophomore years, and that never graduated, never got out of school. It's entirely logical. Some people go to school, aren't really prepared, it's not the right thing. That's where the defaults are concentrated. If you then said you graduated from school and are going to graduate school, the default rates go down by about 60%. If you then look at the top schools, we're currently at 79, we hope to get to about 150. The default rates go under 100 basis points, and this is the entire Duke universe. This is people that are freshmen, sophomore, that may never get out. Not all the graduate schools, and it's certainly not all the people that graduated from this school and then got a job, which is our focal point as a business. So you see over here, when you go try to make a loan, the probability here for somebody that graduates from the Fuqua School, the probability that they're going to default is probably half of this figure. Now that's the national figures right over here, and you see the huge difference. The government runs the student lending program today and its budget. It's actually theoretically a contributor to our revenue streams. It's actually a money loser for the government because the default rates are very high, and they probably are 300 or 400 basis points underwater on the $1 trillion each year. But if they were more sensible about how they allocated funds, they would find their default rates going way, way down. This was also thrown in by our marketing people, maybe because Jeff Gunlock is a friend of ours. This is this soaring delinquent student loan. I think there were two contributing factors to this. The first was clearly the expansion of the for-profit school programs in the 2003 through 2007. I think those abuses were well cited. The second part is more a deep cyclical aspect. We just went through, unquestionably, one of the most difficult recessions in the country's history in the last century. I would argue, certainly in the financial services business, it was only comparable with the 1930s. For most economic activity, you could only put a couple of the recessions, 73, 75, and the 1930s as comparable, and that had a major, major impact. And I think it skewed people's understanding of what the risks are, because that weight of that delinquency falls on people that are starting careers and don't have professional experiences yet. So this is what we're trying to do at SoFi. And by the way, can I just say it's extraordinarily hard work, because this part, for you guys, we have an unquestionably better product. So it's easy. Every time I can talk, in fact, our marketing guys are lucky. They get to go to these things and go, you've got a much better product. We use a series of aspects to try to link investors. Alumni are a big part, but we have other institutional investors into this program. The ultimate objective is that we have a system that provides you not just the money, but plausibly other aspects to your career. Networking, career mentorship, and then we have programs like the Entrepreneur Program. Today, I think we've made about 1,400 loans over the last, I think about 4 months. 2 people have lost their jobs. One we found, the other guy I'm meeting on Friday morning for breakfast in New York. The other thing we do that's different than a bank is that we use our network of our investors, our friends, our company to help folks through challenges. We think it's an entirely logical and plausible business strategy. We want people to be able to pay our loans. And we look at these people as customers that are lifetime customers, that everybody here, I can speak to that for certainty, you'll have some point in your life that something is a little more challenging, either personally or professionally. It doesn't mean that the person isn't a fantastic person who's dedicated. So we take that perspective that this is a long-term relationship that we have with people, and that people are going to, absent physical or mental illness, have setbacks. We're going to try to work through those issues with them. You always have to have a testimonial. I think they said that probably in one of your earlier business classes. So Celia, who probably was hanging out at Santa Barbara from what I can tell in the background, she seems to be with some person and is very happy and is in the California sun, which is not a bad way to go. I probably wouldn't be thinking about my student loan at that time, but obviously she was. Benny Joseph is one of our borrowers who participated in our entrepreneur program, where we provide some economic relief for people that try to start businesses. He has started a tax planning app, which makes people that are in early or mid-career more efficient with tax planning decisions throughout the year rather than waiting to this time of year. When you get to my age, you think about that every time, but maybe when you're 28 or 30, you don't think about every decision you can make, particularly if you're starting a business. I think that's most relevant, and Benny's focused on that and doing some really great work. And there's a final component. I told you we were at Stanford, going up to Harvard later this month, and been up to Wesleyan and a number of other schools. I'll get to most of them, I think. Over time, and schools like Duke and Harvard and Stanford are maybe not necessarily the best examples, but if you take great schools above maybe the top 10 in terms of their endowments, we are thinking about how do we contribute to the schools over time. We believe that our investment product for alumni can provide an important gap in their connection to their school. People come out of school, sometimes like you guys will have indebtedness and you start off with your lives. And although the school would love to have you have participation in donations, and you might, you're going to have a cycle of your life for many of you where you're going to need to deal with your own economic objectives, plausibly home ownership, saving money for plausibly for kids' education, which I think you will have learned is quite expensive, and other things in your life, retirement. What we hope to provide is a plausible gap that people remain connected to their school, that as they get in through their mid-30s, that they take some money and think of investing it basically in what they were before. Student borrowers use that capital to accumulate some interest, use that to fund people from the place that hopefully they had both an emotional and economic attachment that had helped advance their lives. and make sure that we ultimately, over time, try to link that. So as people become, the sets of people that become ultimately more financially safe and available, they can move from both lending money to the school to being more philanthropic and donating to the school. So we're hopeful that over time it's a life cycle component to SoFi and to the schools. And I think this must be our concluding slide, which is funny. I've never worn those shoes. I did when I was at KKR. I was one of the venture founders at Solyndra. I used to have a Tesla Roadster. It's quite uncomfortable to say. And my dad ran Exxon's European refineries when I was a kid. I think the point of this slide is that you can build really great products that satisfy consumer needs, and you can actually do really good work. I talked earlier about morality. I know from Exxon, forget Valdez and stuff, they fund tremendous amounts of research and engineering. You always hear, I want to be careful I say this, you hear arguments about oil companies and things. Oil companies are actually owned by kind of average folks and pension funds. Most of the folks that work at an oil company make less money than the average federal worker. Now, there's a few people at the top that today, used to be not this way, don't make a lot of money. They do lots of good things. They do some things that are not so good. But they are overall, I think, a force that tries to improve and add, and they've done a lot on the natural gas side. Solyndra was actually an intelligent idea. It was really about, I don't know if anyone knows the Solyndra story, but it was about trying to figure out a cheaper, less expensive way to put on panels. I think the criticisms have been unjust because it was a plausible business strategy when it was devised, but business strategies don't always work out. And they ran into a much more cost-effective competitor out of Asia, which they're not the first or last company that will run into that. Tesla is still not profitable. I think their new car is a fantastic product. I hope it's wildly successful because it gives you all the excitement of a really nice, fast car, which I love, but it's much more comfortable than their previous products, so they're improving. And I'm not sure what the heck these shoes are, so I can't speak to them. And SoFi is what I've talked about. I encourage you to look us up on the web. If you ever have any questions, shoot us a note. We'd love to build a deeper connection to Fuqua and all of you. And I cannot still believe that I'm actually speaking at a sustainable conference. When I told my daughter, who's a Stanford freshman, she goes, "You're speaking at a what?" She goes, "This isn't normal, aren't you?" She goes, "You mean you're not on a fundraiser now?" Anyway, thank you very much for your time. I appreciate it. And thank you for having me.
Produced by Duke University. Online at duke.edu.